Welcome to Echo 315, Study Session 8, Introduction to Capital Budgeting. Introduction. Thus far, we have seen how to analyze financial statements and solve financial problems like annuity, sinking fund, amortized loans, and annual percentage rate. In this study session, we'll examine the nature, purpose, process, and methods of capital investment appraisal. We will concentrate on non-discounting methods. Learning outcomes. When you have studied this session, you should be able to 1. Explain the purpose of capital investment. 2. Outline the stages involved in capital budgeting process. 3. Analyze methods of appraising investment. Corporate plan and capital expenditure. Corporate planning is a long-term strategic plan of action involving a review of the objectives of an organization, the environment in which the organization operates, an assessment of its strengths, weaknesses, opportunities, and threats. The corporate plan will include plan and financial implications of the plan. The capital expenditure term commitment of resources to realize future benefits. Proper planning and control of a capital investment help management in allocating funds to investment that best assures the achievement of planned short and long range operating plans. Purpose of capital investment. Expansion. This includes expenditure to grow the business, make new products, open new outlets, invest in research and development. Maintenance. This includes expenditure to replace worn out or obsolete assets or to improve safety and security of existing non-current assets. Profitability. This includes expenditure to achieve cost saving, quality improvements, and improvement to productivity. Indirect purposes. This includes expenditure which is necessary for the smooth running of the business but not directly related to operations, e.g., renovation of office building. Nature of capital budgeting. Capital expenditure is normally irregular and is for large amount that is expected to generate long-term benefits. There are distinctive features of capital investment which makes it worthwhile developing and applying a special set of appraising. The sums involved are relatively large so that bad decisions may have very serious consequences. The time scale over which the benefit will be received is relatively long so that a business has to live with any mistakes for a considerable period. The whole nature of a business and rate of progress is ultimately affected by its overall investment program. It involves waiting for recoupment of expenditure, and because money can be used to earn interest, waiting as cost, that is opportunity cost. A typical capital project involves an immediate purchase of a non-current asset. The asset is then used for a number of years, during which it is used to increase sales revenue or to achieve saving in operating costs. There will also be running costs for the asset. At the end of the asset's commercially useful life, it must have a residual value. For example, it might be sold for scrap, or in a second-hand market. Items such as motor vehicles often have significant residual value. A problem with long-term forecasting of revenues, savings, and costs is that forecasts can be inaccurate. However, although it is extremely difficult to produce reliable forecasts, every effort should be made to make them as reliable as possible. A business should try to avoid spending money on mystic and unrealistic forecasts. It is important that the assumptions on which the forecasts are based should be stated clearly. If the assumptions are clear, the forecast can be assessed for reasonableness by individuals who are asked to authorize the spending. Stages of capital budgeting process. Stage 1. Forecast capital requirement and planned expenditure. Investigate deviations and monitor benefits from project over time. When a proposed capital project is evaluated, the costs and benefits of the project should be evaluated over its foreseeable life. This is usually the expected useful life of the capital asset, which will be several years. This means that investment projects are as follows: A. Payback period method, or benefits through cost. Payback period method. This is the period, usually expressed in years, which it takes the cash inflow from a project to equal the cash outflow. It is the length of time required to recover the amount of initial investment. For a project with constant equal cash inflows, payback period equals initial outlay divided by cash inflow. For a project, compare it with the initial outlay to determine when they will be equal. Alternatively, you may calculate the cumulative cash flow and examine when it will be equal to zero. Advantages of payback period. It is easy to understand. It is simple to compute. It was useful in situations of rapidly changing technology and improving investment conditions. It uses cash flows and not accounting profits. Disadvantages of payback period. It ignores timing of cash flows. It is subjective. It ignores project profitability. Accounting rate of return. The ARR is sometimes referred to as return on investment or return on capital employed. It measures the profitability of investment from the conventional accounting standpoint by relating the required investment to the future annual net profit. Thus, ARR equals estimated average profit divided by estimated average investment times 100%, or ARR equals estimated average profit divided by estimated initial investment times 100, where average investment equals initial outlay plus scrap value divided by 2. Advantages of ARR. It is easy to understand. It is simple to compute. It recognizes profitability factor. It links with other accounting measures. Disadvantages of ARR. It ignores timing of cash flows. It uses accounting profit instead of cash flows. It ignores project life. It is subjective. It varies depending on accounting policies. Summary. In this study session, you learn that the capital expenditure decision is within an organization's long-range plan. The possible purpose of capital investment include expansion, maintenance, profitability, and other indirect purposes. The main methods of investment appraisal include payback period, accounting rate of return, net present value, internal rate of return, and profitability index. The payback period is the period which takes the cash inflows from a project to equal the cash outflow, while the accounting rate of return measures the profitability of investment from the conventional accounting standpoint. This is the end of study session 8. Thanks for listening.